Fritz, when we exclude Japan and old Europe from the portfolio, where in the internationally emerging markets should we look? And here, what he's referring to is our analysis suggesting that IFA is not a place to invest. And that's what he means by Japan and old Europe. So my response to the question is that to the extent you invest at all internationally, and I think that's a really good question, why do you want to do that? Because the correlation of foreign markets to the S&P 500 is over 90%. But to the extent you do want to do that, then my suggestion would be to go to active management and find mutual fund, find actively managed funds that have clearly demonstrated their ability to outperform the IFA benchmark and to keep up with the S&P 500. Those would be the two tests in my mind. And I say active management because if you're going to index to the IFA benchmark, that's my point. That's where you're probably making a mistake. And then the question is, well, what about emerging markets? Well, emerging market index is, I think, 40% weighted in China. And just as a subjective matter, I don't think I want to be investing in China. So then the question is, well, are there unconstrained global funds where good fund managers can find opportunity in all the rest of the world, which is not IFA, not China, but let's say Malaysia, Philippines, South America, you name it? And the answer is, it's possible that there are. I don't know the answer. I don't have any fund recommendations. If I did, I wouldn't give them. I don't want to be recommending individual funds. But the test then is, well, if you look at the Sharpe ratio, are they keeping up with the S&P 500 or not? Pretty simple. So that's a long-winded answer to the question, and it's a maybe, maybe not. And you advisors would have to then sift through of all the active managers out there. Is there somebody who's actually adding value? Number 8, what do you think about the wealth tax proposed by Warren or Sanders? And as I've often said, I don't want to talk politics and I don't want to give political opinions. All I can say on this is that wealth taxes were tried and discarded in a number of European countries for various reasons. Wealth taxes were very difficult to administer, and what I mean by that is that what they led to was a lot of hiding of assets, a lot of what do I want to say? Assets fleeing France, for example.
Leaving the country, moving the assets, changing citizenship.
Changing citizenship. So you have capital flight. That's the term I wanted to use. You had a lot of capital flight, which can't be good for any economy. You need capital to get reinvested in your economy, and so I think those.
You're not talking about a VAT either. You're talking about.
Oh, no, this is not a VAT. No, this is simply.
A wealth tax is just define that.
Right. So the wealth tax that Elizabeth Warren is talking about is the 2 cents. You may be familiar with that concept, but what she's saying is, okay, over a certain amount, a threshold, then we're going to charge you 2% of the total value of your assets every year. Well, think about how difficult that would be to administer, for one thing. You'd have to have all these assets valued every year. And for many people, these are not liquid assets. They're companies, private companies, and so forth. Well, just the administrative and the costs involved with that would be enormous. And then so to figure out what are we charging 2% on, so enormously costly, enormously complex. And then this issue of capital flight, people saying, well, the heck with that. I'm going to move all my assets to Barbados or somewhere and change my citizenship and probably not reinvest in the United States. So anyway, those were the reasons that the wealth tax was abandoned, tried and abandoned. And that's what I think about the wealth tax. Okay, here's question number 5. Will we have enough jobs to handle the increased population? And this is a segue into, well, where have jobs come from? Because this is a perennial question, I should say. A perennial question meaning that, well, we've had constant growth in the population. We have constant progress, technological progress, and the question always, every generation, every decade is, well, where are the new jobs going to come from? And the answer here, I think, is found in the transition that we've seen in the U.S. economy in terms of job categories. So manufacturing as a percent of total jobs was 37% in 1950, and today is just 10% of the private sector, and actually 8.6% of total if you include government jobs. Manufacturing jobs today, just 8.6% of total jobs. And so then the question is, well, if we lost manufacturing jobs, where did we pick up new jobs? And the answer is education and health services and professional and business services, largely. And the reason I'm making this point is because when you think of those two categories, in other words, the two categories that have posted the biggest gains in employment, those are services industries. And growth in employment in services industries is strictly a function of increased population. So the answer to the question is, where will we have enough jobs to handle the increased population is, of course, because growing population spawns increased demand for people that work in these services categories. For example, hospitals and healthcare. The more people you need to do the work in those businesses, and similar for professional business services. So to me, it's a no-brainer. I mean, the answer to the question is a no-brainer. Here's an interesting chart that I just pulled from the BLS publication called Employment Projections, just published September 4th. And if the question is, well, okay, so where are the jobs going to come from, assuming these increased population forecasts? The answer is, according to BLS, from 2018 to 28, the biggest employment increases will occur in healthcare and social assistance, no surprise there, and then leisure and hospitality, and that's restaurants, hotels, and other things like that, and then professional and business services. So exactly what I was saying, increased population spawns its own growth in those services, businesses that grow as a function of growing population. Question number 9, if Democrats take the presidency and possibly the Senate in 2020, do you think that there would be a probability of increased corporate taxes? And if that were to happen, wouldn't that negatively impact corporate earnings? And to answer this question, I guess I'd refer back to what happened in 2018 when we had the corporate tax cut. And the answer there was half of the 23% earnings jump that we experienced in 2018 is being attributed to the income tax cut, corporate income tax cut. So conversely, if it were to happen for whatever reason, but if we had corporate tax increases, then probably you'd have a one-time cut to reported earnings, which would probably result in a hit to stock prices, but probably on a one-time basis. And then you would have a resumption in earnings growth, presumably, after you have that one-time hit. Although earnings growth subsequently might not be quite as fast, because then you're taking a little bit more in taxes out of corporate earnings, leaving less available to shareholders. And so that's probably the way it would work. For what it's worth, my own opinion would be it's a real long shot, I think, for to assume that the Democrats would gain absolute control of the government, meaning the two houses and presidency, and reverse these tax cuts. I think that's probably a stretch, but nonetheless, if we had it, it would not be good news for the stock market. This was a great one. Number 4, in a future slide, this volatility graph should show S&P 500 as well.
Yeah, but just to be clear, you're not saying Democrats would actually do that. You're saying that the likelihood of them gaining control of both houses and the presidency, and then reversing this, reversing the tax cut on corporations, that's what you're saying in totality. Those things are unlikely to happen.
Well, I'd say that the Democrats actually taking control of all three is a long shot, but I would say that if they did do that, probably it's a high probability that they would want to reverse those tax cuts, and probably would be able to do that because that's what most of them are campaigning to do, is to somehow raise taxes and get more revenue for the government. But I'm saying yes. So I think if they were elected, if they took all three, they probably would reverse the tax cuts and be successful in being able to do that. But I just don't think it's a very high probability. So anyway, back to this chart. What he's saying is change your slide, or incorporate in your slide the S&P 500 and superimpose that on top of volatility, which I thought was a great suggestion. So this is what we've done, and this is actually the slide that I'll continue to run in this regard. And the point is here that, and what I always say when I introduce this topic of volatility, well, volatility usually surges big time when the market sells off, and lo and behold, you can see that perfectly here. So the big surges in the red lines occur coincident with big declines in the stock market, and that's what shakes people up. It just seems like it's a lot rarer for the big surges in volatility to occur in big upward moves in the stock market. That doesn't happen. But what does happen is market plunges on heightened volatility, which really shakes people up. And so now we've improved that graph, and I want to thank that guy for suggesting that. Number 1, can you elaborate why banks do not tighten with an inverted yield curve? Here I clipped this article from the Wall Street Journal. I think it's either today's or yesterday's Wall Street Journal. I can look that up if you need it. But the interesting piece of this article was net interest margins here. And you can see that with the inverting of the yield curve, it did result in compressed interest margins to the extent that banks' cost of funds rose compared to the rate at which they could earn on those loans. And so interest margins have been under pressure with the yield curve inverting. But going back to the question, why don't banks tighten? Meaning, he means by that, why haven't banks pulled back on the amount of loans they're making if their loans are less profitable? And the answer to that is actually they're going the opposite direction. What they're doing is, because their margins are under pressure, they're trying to make it up in volume. And so we've seen real strong gains in loans outstanding. And again, I'll say it again, because banks are operating with lesser net interest margins, they're trying to make up the profits in increased volume. So they make less profit on each loan, but they're trying to make more loans. And the second part of the question, I think, probably deserves pointing out, that the yield curve actually now has flattened compared to the inversion it was experiencing, and I'm going to show you that in a couple more slides. But So this problem is going away. This problem being an inverted yield curve has already gone away substantially. Number 3 question was, would you include REITs in a portfolio? And it's a great question. And actually, I'm surprised somebody would ask that question. I'm not sure people always are looking at the data. But yes, of course, absolutely. REITs have been the best performing asset class over the last 25 years. And I think when I look at the 50-year data, it's the same thing. So absolutely. When we look at the pie chart and revising it for not owning IFA or commodities, I would absolutely include REITs. And in fact, and you and I were working on this the other day, Andy, but when you said, okay, wait, so how did you reallocate?
Yeah, exactly. Yeah.
And I simply doubled up on large cap, U.S. large cap and U.S. small caps. But in reality, what I would do, and maybe what I should do, is recalculate, saying, okay, let's do that.
That would be great.
Let's split it 3 ways and up the allocation to REITs. Absolutely, I would do that.
Yeah, I think when I asked the question, I had no idea that the answer would be that. I was surprised that it actually increased and lowered risk on the total portfolio, I think.
Yeah, I should split it 3 ways. And anyway, the answer to this question is, oh yeah.
It's just beefing up the risk assets, but it does open you up to the criticism of going from 7 to 5 and getting less diversification. But you're arguing, does it really, since they're so highly correlated anyway, those markets?
Well, man, you are so smart. It's exactly
but not commodities. Not commodities, is it? Not commodities is not.
Commodities is correlated because it's a dead asset. It's not correlated with anything. It just stays 0 all the time. No, but yeah, I mean, I'd have to run the correlation coefficient, but it doesn't matter, because if an asset isn't generating any return, there's no reason to hold in a portfolio, even if it is countercyclical, even if there were a negative correlation coefficient. And this is so often I think the trap people fall into. And even with arguing you need to own IFA. Well, yeah, but sometimes when S&P is down, IFA is up. And that's not an argument to own IFA if over the long term the asset isn't contributing. It may dampen volatility, but it's a big drag to performance over the long term.
Yeah, but I'll be interested in seeing, in doing a follow-up on that, for consumers, addressing the
it's going to enhance the purple dot. It's going to make the purple dot look even more spectacular. That's what it's going to.
But I'll
do that.
But the other thing is, it's gonna make it more efficient, that portfolio, but it also just it explains what you mean by a risk asset. I think that it's a risk asset, unlike, it's different from bonds and right. In that it's more capital appreciation, I guess. Is that it? That's the main difference?
Yeah, it's more capital appreciation. And also you can see that it is a risky asset class, in that in this chart, for example, you can see how REITs were extremely volatile from 2006 to 2008. REITs had the biggest plunge. That's because they went up the most, unlike bonds, which are pretty stable in all environments over time. So that's why dot plot for REIT here is lines we're talking about this. Let me just pull it up. Unless you want to keep moving along, but
keep moving, but I would like to just get nailed. Maybe I shouldn't call it a risk asset. We should be calling it something other than that. But that's the term.
No, it's a risk asset, no question about it.
Okay, yeah, that's the term I've seen used to describe it in literature. So okay.
Stocks and REITs and MLPs are all risk assets. Okay, so enough on that. Would you include REITs in the portfolio? Yes. Okay, you can see the question here. Fritz, could you talk about keeping retirees fully invested? They seem to have more concerns about a possible recession than those that are retiring in 20 to 30 years. Thanks. And a related question was number 10. To say technical analysis works until it doesn't work can also be said for buy and hold through an economic recession. When high net worth clients age 60 to 80 are already down 20% or more, their emotions will prevail over strategy no matter how well we educate them. Perception is reality. So great yeah, great points here, and absolutely true. And so just a number of thoughts in this regard. First of all we can do is our best to try to educate clients. And in my experience, there are those clients who are not who are not teachable. They will never be comfortable, and so to tell them that piece of the portfolio should always be invested in common stocks is just wasting your breath.
What percentage? What percentage in your experience?
There are no studies on this to my knowledge, and this is simply based on my own experience. But and there are those people where you're wasting your breath, and you really shouldn't even try to push probably in that direction, because what they're going to say, if at best they'd say, okay, that all makes sense to me, and you're talking about this modern portfolio theory stuff, that all sounds good, and it all sounds good until they're down 20%, just like this guy says, and then they freak out and they bail, and they will end up bailing right at the bottom of a bear market. They're down 20%.
But what percent in your experience? I know it's a tough question, but I'd love to hear your answer.
I just can't quantify it. I just can't. It's just so difficult because, and again,
is it 20 or 50?
I wish I knew, Andy. And in my experience, when I say that, I mean, in talking to financial advisors for the last 25 years. And so it's secondhand. I mean, I had clients at one point in my career, but what I'm really saying is in talking to advisors over all these years, you get a sense for, well, how clients react. And so let me just describe the other extreme. On the other extreme, there are clients, even who are in their 70s and 80s, who say, yeah, I've been investing for 60 or 70 years, and this stuff doesn't bother me in the least. My portfolio can be down 20%, it can be down 40%, and I know it's going to come back. Literally, I've heard people say that. Old guys, geezers, who are so knowledgeable and they understand, and it doesn't bother them in the least. So these are two shocking extremes. And so when this guy says they're already down to, and emotions will prevail, he's absolutely correct with respect to one subset of the universe, but he's not correct with respect to the other extreme. So I guess the conclusion is that all we can do is try to educate them, and that's why we use this chart. So for example, I was thinking about this earlier in the day. Here's an episode in which from the peak in 07, the market was cut in half. Market's down 50%. Yeah, and we remember those people who freaked out, but I also remember so many who made no move at all, and then the market was up 300%. So you're down 50%, but up 300% over the next 10 years, and vindicating this whole notion of modern portfolio theory. So I guess all I can say is we have to do our best to try to educate clients to do best for them to optimize their long-term returns, but recognize that for some people you'll just never change their behavior or their attitudes because they're just too risk averse to actually behave properly when you do hit a recession. That's all I can say on that. I just don't. It's just a tough one, just a really tough one. Question number 6. You mentioned that for the most part, we're at maximum velocity in the economy. Can you unpack that a bit? What data would you use to support that? So first of all, let's just look at today's economic forecast, and I just updated this, so this was just published by the Wall Street Journal for the survey taken in October. And again, economists believe that economic rate of growth will slow to an average of 1.7% in the 5 quarters ahead, and that's coming off of 3.1 and 2%. So we had this surge at the end of last year, and for the full year last year, related in part to the tax cuts. But the notion being that anything over 2% is not sustainable. So this guy wants to know, well, so how do you come to that conclusion? And the answer is then, in starting with this chart, that here's the Congressional Budget Office's latest 10-year forecast, and from an estimated 2.3% GDP growth this year, then they are estimating, just like the private forecasters, but looking out a total of 10 years, a gradual decline to something less than 2% over the next 10 years. And the way you get there is that, as we're talking, as we're illustrating here in the top of this chart, GDP growth potential is a function of growth in the labor force and growth in productivity. And so if we look at estimated growth in the labor force, you can see that Congressional Budget Office says, we're looking at a very substantial slowdown in growth in the labor force, and this is a function of demographics here in the United States, specifically from 1.1% actual growth in labor force last year to something declining all the way down to just 0.3% growth in 2026. So averaging.
That looks a lot steeper than the demographic curve. When you look at that chart with the comparative demographics.
And what happened was that growth in the labor force is a little different than growth in the working age population. And that's the curves you're talking about. Growth in the labor force is capturing people that were on the sidelines. And so you actually saw a shrinkage in the labor force coming out of in the recession. We never had a shrinkage in the working population, but it has to do with the labor force participation rate. And so we've had this recovery surge in participation, driving the labor force to in excess of 1% growth year over year. But the conclusion here is, but that's not sustainable, because at some point you reach full employment, and then the labor force can't grow any faster than the working age population growth. Does that make sense?
Yeah, but the labor participation rate has continued to surprise on the upside.
Surprise, but I think what economists would say is, well, yeah, it has been a really positive, welcome surprise, but it's not sustainable, and so we're going to have a drop off in growth in the labor force over the next 10 years, pursuant to this forecast, or consistent with this forecast.
Yeah, and one thing is that that is really expecting current immigration rules and rates to stay the same, isn't it?
Yeah, in fact, I have a chart on that I didn't get to, but I have a new chart on that, and which is a really interesting topic. Yes, that those forecasts for continued growth in working age population in the United States do include the assumption that we're going to continue to accept immigrants at historic levels. And then the question is, well, what if you didn't? And the answer is really surprising. This is Pew Research data that I have. I'll show you the chart. But if we didn't assume continued in-migration, then our country would look just like Europe and Japan, interestingly, because the fertility rate has plunged.
Not to be political, I think we owe it to people to say that somehow.
I will. Okay, in the next webinar, I'll include that chart. I would have last time, I just didn't have time, but I will include that chart.
That's pretty amazing.
Yeah,
pretty
it
important.
is.
It's important. It's like really fundamental.
Yes, it is. Yes, it is. And and it goes beyond politics. So yes, actually, I will definitely include that, because I was really surprised when I saw the numbers, and it takes a little doing to generate those numbers. So I thank Pew Research for doing the numbers, because um, it's an important topic. Okay, so back to this, the twin drivers of GDP growth, productivity and labor force. So this is labor force. Now let's look at productivity, and we're seeing that CBO is saying, well, from 1.3% productivity gains last year actual, they're assuming a pretty substantial recovery in productivity, but productivity averaging, let's call it 1.75% looking out the next decade, something like that. So what they're saying is that you add the two together and then you get something, a little less than 2% total GDP growth looking out the next 10 years. The numbers don't add up perfectly because, again, there are assumptions relating to labor force participation, I think, is probably the biggest swing. But anyway, that's in round numbers. That's how you get, let's call it a 2% GDP forecast is kind of the consensus, or a little less than 2%. And the reason is because you've got declining growth in labor force, even though you're having some increase in productivity gains. At the top of this chart, do you think the Fed will lower interest rates? Question number 11. First of all, let me talk about the yield curve and what's happened. And I think I said just a couple of minutes ago, the red line, dark red line, is today's yield curve. And so you can see that from maximum inversion September 3rd, I went back and I looked at what was the point of maximum yield curve inversion. It was September 3rd. So from maximum inversion, then today's yield curve has substantially flattened. It's still not flat, but it's lots flatter than it was. So the yield curve hit a maximum, and now it's already coming back down in terms of steepness. And my answer to the question is, I'm not sure what the Fed will do. And I think that's what they would say too, because, and I think this week we're going to hear a whole bunch of different Fed officials' speeches. There are a bunch of them scheduled for this week, so we'll get more insight. But I think the point is that we know that there's a real division within the OMC. There's no clear consensus. And so this is the topic that's under debate. So I have no idea what they're going to do next, and nor do they. If I were simply going off the numbers, I would say, well, I don't think there's any reason for them to cut rates any further. I think we're probably in a great situation right where we are. The yield curve is a little bit inverted, but it certainly is not any hindrance to the economy at present. That's because in absolute terms, rates are so low. And as I pointed out earlier, banks are pushing money out the door because their margins are a little bit under pressure, and so they're trying to make loans as best they can, which is a great situation. So we are awash in liquidity, and there's no reason to think that the Fed needs to cut rates further to stimulate the economy anymore. And again, the argument against cutting rates further is, well, let's leave some ammunition, dry ammunition, in case we do run into a recession, then we can actually cut rates from where they are at present. So I don't know what's going to happen, and I'm not sure that it matters a heck of a lot. And then a related slide here is, again, you can see the yield, what the yield curve has already done, and it looks like we've hit bottom in this chart, portrayed in this manner, so that maximum inversion is behind us, and now the yield curve is only minus 15 basis points, which is pretty close to flat. And so that's just an interesting observation. And you can see it. Well, anyway, that's enough on that. But so
yeah, and it kind of looks like past events that occurred that were not followed by recessions.
No, right. And again, what most people are looking at are these two episodes where the Fed pulled back in time and
Yeah.
actually drove. Yeah, and so people are saying, and the other thing that's different this time, Andy, is, and the argument is one of the most prominent arguments is that, yeah, but the long end is being held down artificially. If it weren't for the European Central Bank pushing Bund yields down below zero, then so it's an artificial bending of the yield curve, I guess, would be the best way to describe that. And so the comparisons aren't fair, is probably the best way to say that. So if it weren't for the ECB, our yield curve today would be pretty steep, is the argument being made. I think
Well,
there's something to that.